In the years leading up to the 2008 financial crisis, the housing market in the United States was completely booming. It seemed like the new gold rush for both homeowners and investors. The main reason for this was due to an increasing availability of mortgages, including subprime mortgages.
So whenever you hear subprime, think
Subprime mortgages essentially made it a lot easier to get mortgages. You're homeless and want to have a home? Sure thing, buddy. Here's a subprime mortgage. Sounds like a bubble, right? Yes, you're right. But financial institutions didn't care, and they began bundling these subprime loans into mortgage-backed securities, which then got sold to investors. It seemed like a safe investment considering the housing market was ever rising, but the value of these securities under the surface was not exactly very high. Then came CDOs. These were essentially repackaged mortgage-backed securities, which ranged in terms of risk, except the higher-risk CDOs gave higher returns, which attracted investors. You might be confused, but just know that this is bad, very bad. Michael Jackson bad. The housing market was soaring, but it was like building a mansion on cracked foundations. Sooner or later, it's going to crumble down. The realization period. As the mid-2000s rolled around, the cracked housing market foundations were starting to show. Not majorly, but enough to cause concern in those who were looking. And there were people looking. Although the housing market appeared strong, a select few hedge fund managers, such as Michael Burry, were seeing the cracked foundations and realized that the housing market was nothing but a ticking time bomb. And, as savvy investors, they wanted to profit from it. Credit default swaps. Essentially a way of betting against the housing market. Banks were happy to hand these out left, right, and center, because who would bet against the housing market? It was booming. Banks who were heavily invested in the idea of the mortgage-backed securities and CDOs were riding the wave of the housing market rise. But as 2007 rolled around, the cracks in the foundations were becoming visible to those who didn't even want to look. New homeowners were struggling to pay their mortgages. You know them subprime mortgages from earlier. And this was when the bubble finally popped. The crash. The 2008 financial crisis, often referred to as the Great Recession, was literally catastrophic. The housing bubble had popped and the mansion was crumbling from the foundations. The American economy was literally being tanked. And you know what that means. The crash became worldwide, with banks and institutions all across the globe getting destroyed due to their ties within the US housing market. Usually the banks find a way out of stuff like this, but no, not this time. Financial institutions like Bear Stearns, Citigroup, Deutsche Bank were on the brink of disaster. But the Lehman Brothers, one of the leading financial institutions in the country, fell over the brink and went bankrupt. This was a major indicator that this was not good at all. The housing market that was once looking invincible, undeniable, unstoppable, had just been absolutely decimated. Institutions were making so much money from these subprime loans and CDOs that they completely took their eyes off how bad they really were. The wider impact. The wider impact of the Great Recession was pretty devastating. Unemployment rates were absolutely spiked due to the closure of many businesses and institutions. The widespread joblessness created financial trouble for many households as people struggled to make ends meet in demolished economies. For many, the crisis led to homelessness due to unpayable mortgages or massive losses in their investments, or a multitude of reasons actually. Retirement savings were also tanked as the stock market faced steep declines. Countless people saw their hard-earned money and investments fade into disaster, causing a lot of grief and uncertainty about what their future looked like financially. The 2008 financial crisis stands as a harsh reminder of how something can look so good on the outside, yet be so damaged under the surface. It has taught us the lesson that we need to really look into what we're investing in and to always invest with caution, because things can go from good to bad in the blink of an eye. That's all. Hit subscribe for more content in the future. See you next time. Now get out of here.